All right, let's talk about Red Hill Minerals, or RHI on the ASX. Now, if you're a resources investor, you know the classic dilemma. Do you go for safe, reliable income, or do you chase that massive upside of a major discovery? It's tough to get both. Well, RHI thinks they've cracked the code.
So what's the big idea? Well, at its core, RHI is running what you could call a hybrid model. They're trying to combine the best of both worlds, the steady, long-life cash flow you get from royalties with the huge potential upside you see with mineral exploration. Think about it. A pure royalty company can sometimes feel a bit stagnant growth-wise. And a pure explorer? They're always tapping shareholders for cash, which means dilution. RHI's whole structure is designed to sidestep those exact problems.
So here's how we're going to tackle this. First, we'll dig a little deeper into that hybrid thesis. Then, we'll look at the royalty engine that really drives the whole thing. After that, we'll see what that means for you, the shareholder, in terms of dividends. Then, we'll get to the exciting part, the self-funded exploration. And finally, we'll wrap it all up with valuation, risks, and the outlook.
All right, first up, let's talk about the Onslow royalty. And honestly, this is the absolute foundation for the entire company. We're talking about a massive iron ore royalty from a project run by an industry heavyweight, Mineral Resources. You really have to understand this part, because everything else we're going to discuss today is built right on top of it.
Okay, look at this number. $11.88 million. This is what changes the game for RHI. In fiscal 25, the company pulled in almost $12 million in royalty payments. And let's be clear, this isn't some forecast or a rosy promise. This is actual cash in the bank. And it's what transforms RHI from just another developer into a genuine, self-funding machine.
And this chart, wow, it just perfectly shows you the scale of that ramp-up. I mean, look at this. In FY24, the royalty was just getting started, barely a trickle at $280,000. Fast forward just 1 year, and it absolutely explodes to nearly $12 million. We're not talking about a slow, gradual climb here. This is a massive step change in the company's financial power, all because the Onslow project really hit its full stride.
So let's get into the nitty-gritty of the royalty itself, because it's pretty smart. It's a 0.75% free-on-board royalty. Now, what that basically means is RHI gets its cut based on the sale price before all the shipping costs are taken out, which is great. And as you can see, it's been structured for the long haul. It doesn't just cover the main project. It also covers potential future expansions. For an investor, that provides some really nice, clear long-term visibility into where the cash is coming from.
Okay, so the company's got all this new cash flowing in. The big question is, what does that actually mean for you, the shareholder? And that brings us right to our next section, dividends and returns. Let's see how this royalty income makes its way back into your pocket.
And look, the company has been really upfront about this. Back in April 2025, the board put a formal dividend policy in place. And the target is simple: give 50% of the royalty money directly back to shareholders. This isn't just some vague promise down the road. It's a clearly stated policy. It creates a direct line between the project's success and what ends up in your bank account. Okay, this is where the rubber really meets the road. We can actually model out what the dividend might look like. So, assuming that 50% payout policy and production hitting about 35 million tons a year, you can see a direct link. As the iron ore price goes up or down, so does your potential dividend per share. It gives you a really clear picture of how what's happening in the global commodity market could directly affect your income from this stock. So let's put some real-world numbers on this to make it tangible. Say you're an investor holding just over 2,800 shares. At a projected 27 cents per share dividend, that works out to be about $1,085 in grossed-up annual income.
And if we round that up to an even 3,000 shares, you're looking at around $1,157. The point is, it becomes a pretty meaningful income stream. You could take that as cash flow, or you could turn around and reinvest it to let the power of compounding do its work.
And here's a really important piece of the puzzle, especially for Aussie investors. These dividends are fully franked. Now, what that means in simple terms is that the tax has already been paid by the company. So for eligible shareholders, those franking credits are like a bonus on top of the cash you receive. It grosses up the total return, adding some very real value.
Okay, so that's the income pillar of the RHI story. It's solid, it's growing. But what about the other 50% of that cash? Well, this is where we get to the second, and you could argue the more exciting part of the whole thesis, using that money to fund a pipeline of new discoveries.
This right here, this is the self-funding growth engine we've been talking about. See,
Instead of doing what most explorers do, constantly going back to the market, cap in hand, diluting your shares, RHI gets to use its own money to pay for drilling. It's a way to de-risk that hunt for the next big discovery because they're not asking you for more cash to do it.
So where are they putting this money to work? Well, RHI controls a huge land package. We're talking 1,600 square kilometers out in the West Pilbara, and they've already got some really prospective targets lined up for gold and base metals. Take Barkley, for example. Early drilling there has already hit some nice gold intercepts, up to 7.9 grams per ton. So this isn't just throwing darts at a map. It's focused exploration on very promising ground.
And they're not just going it alone. They're also being smart about expanding their footprint through partnerships. A perfect example is this Curnamona JV. Through a farm-in agreement, RHI can earn a 75% stake in a huge project that's got what experts call Tier 1 potential. We're talking about the potential for massive zinc-lead-silver deposits, the exact same kind that made the Broken Hill mine famous. That name alone should tell you how exciting this is.
But the growth strategy doesn't stop with their own drilling. RHI is also using its financial firepower to buy into other people's success by creating and acquiring new royalties. A good example is the Thomson project in New South Wales. So you see, they're building a whole portfolio of future income streams that will sit alongside that big Onslow engine.
Okay, so you've got these two powerful pillars, stable income and self-funded growth. So how do you actually value a unique model like this? And of course, what are the key risks and the big milestones that we should all be keeping an eye on?
You know, when you put RHI side by side with a typical pure-play explorer, the difference is pretty stark. Your average explorer is high risk, always needs to raise more money, and it's often an all-or-nothing bet. RHI is just different. They've got strong cash flow coming in, they fund their own exploration, and it's all built on those two pillars we talked about, income plus the potential for growth.
Of course, no investment is a sure thing. So what are the risks here? Well, for RHI, they're pretty clear. First, there's commodity risk. Their income is tied to the iron ore price, so if that falls, so does the royalty. Second, there's operational risk. They are dependent on mineral resources to run the Onslow project efficiently. And finally, because the shares are tightly held, there can be liquidity risk, meaning it might not always be easy to buy or sell large volumes.
But on the flip side, there are some really powerful factors that help balance out those risks. First, the balance sheet is like a fortress, absolutely no debt. You've got a very experienced board and management team at the helm. And that tight shareholder register, while it can affect liquidity, it also means you have very stable, long-term shareholders. We're talking about groups like Perth Capital and the steel giant Baowu, who are in it for the long haul.
You know, I think the company's own words from their 2025 annual report really sum it all up. They say they are strongly placed to generate shareholder value through both exploration success and the creation or acquisition of royalties. I mean, that perfectly captures the whole dual-engine strategy we've been talking about.
So I'll leave you with this final thought to chew on. The resources sector is famous for being high risk, high reward. But with this self-funding model where royalty income takes a lot of the risk out of discovery, well, it really makes you ask the question, is this a more resilient, maybe even a smarter way to invest in the space?
And just so you know, for full transparency, every piece of information we've discussed today has been sourced directly from Red Hill Minerals' own public announcements and reports, which we've listed right here for you.